All right, folks, Tim Davis here, and I'm just going to title this video Alert, 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 Alert. I think the markets are definitely in dangerous territory, especially for those buy and hold investors. And I'm going to take some time on this because I want to break down each and every index individually. I'm going to break down the ETFs that track those indexes. I'm going to break down the tool that I like to use in the Wall Street Journal that tracks the overall momentum of the market. I'm going to break down gold, going to break down silver, the VIX. I'm going to break down a lot of different. I'm going to approach this by looking at a lot of different avenues to show you guys what the technical charts is showing us overall for the future of our market. And pay close attention, folks, and share this with somebody because I don't want nobody to be blindsided and think, you know what I'm saying, that the market that we're in glorious times. And right now we're not overall as far as overall market, but there are a lot of opportunities out there to take advantage, even if there's trouble lurking for the overall market such as we are in now. Okay. I'm going to focus my attention mostly on a lot of the longer term charts, such as the monthlies, and maybe a couple of weekly charts. We make Lancet dailies towards the end to get an idea of what we can expect in the near future. But I'm going to point out a lot of things right now, folks, and focusing on these monthly charts. I'm going to start off by taking a look at this S&P chart on the monthly chart. Now, so here's a monthly chart, meaning each one of these candles represent a month for those who don't understand technical analysis or don't understand how to read charts. So each one of these candlesticks representing a month. And I'm going to be taking a look at the candlesticks. I'm going to take a look at the oscillators, which are below this price action up here. Look at all my oscillators below. I have a and the different tools that I use at the bottom. I have a full stochastics tool that I like to use to track momentum. Right below that, I have a wins percentage, and right below that, I have the RSI. These are going to be very, very important over the next couple of months because the oscillators are all pointing downward on each one of these technical tools that I use. They're all pointing downward on a monthly chart. That's a big deal. That is something that you cannot ignore right now, because if you do, you're going to be caught holding a bag if you are a buy and hold investor. I want to say that a lot throughout this video, folks. Buy and hold investors stand a chance to get burned throughout this year and as we head into 2023, where there's a lot of economists and analysts are now all shifting gears, and everybody is starting to talk about a possibility of a recession. Okay, and all the technical tools are showing that that possibility could more than likely become a reality. All right, now let me I'm gonna expand this monthly chart. So I want to just show you guys some extremes, and I want to put it in a way that you can see it for yourself. So here is a very, very tight version of a monthly chart going all the way back to 1970, but we're going to focus on from 2000, which is this circle area got here, all the way up to where we are now. Okay, and just in general, folks, if I was to draw a line from the 2009 lows all the way up to where we are now, let me get rid of this oval first here. Remove. So if I was to draw a line from this point up to this point, that's an extremely steep move, folks. You know what I'm saying? As we were normally staying tight to the vest, and this gold line you see me have drawn, that's a 20-day moving average. And that's going to come in, that's going to be a key tool that I'm going to speak of as to way to track what's going on with this market in general. Normally, if you look back in history, you've always seen price action has normally stayed very, very close to the vest to this 20-day moving average, with the exception of a couple areas. Well, actually two main ones, with the exception of, and I'm at, oh, let me get another drawing tool here. So with the exception of 2009, right here, you see that little gap. So the market got down well below that 20-day moving average, and then we bounce right back up. So anytime there's a space or big gap between the moving averages, normally there's a strong reaction. All right, so now look at what's happening now. So since that 2009 low, all the way up to where we are right now, 2022, there's a big steep climb, a big steep climb. We got a retraction of that climb right about here. That was the COVID plunge. But notice how quick market snapped back and rallied from that point. Well, I think that was nothing but a setup for what's to come in the future. So after we got that big snapback rally, I'm gonna expand this back out now a little bit further. Market drop below the 20-day moving average, but price action stay close together, and we rally right back above it, creating a big space between price action and the 20-day moving average. You can see that space in between the price action and the 20-day. Price action does not like to be too far away from those moving averages. So what does that do? Pretty much puts stocks on a steep climb higher that lasted for about a year. And now look what's happening. This is a monthly chart, folks. Look what's happening now. So now we had that nice big climb higher. But that pretty much was like a like a gasp for one last big plow higher before a possible overall longer term market correction. All right, now look at the oscillators and the full stochastics. When we got that big dip in the the COVID plunge, dip below the 20-day, look at the oscillators. It dipped just a little. It came right back above in the overbought territory. Look at the wins percentage, dip all the way down to oversold and bounce right back. RSI didn't quite hit all the way down to the oversold level, bounce right back. Sharp moves up. Now look at the momentum indicators. It is making a steady climb. I mean, not like here, not like this sudden drop back here, but it's like making a steady climb, a steady climb lower, or a steady stair step down lower. Here we see it, a nice defined lower move here on the wins percentage, and the RSI is playing catch up. My speculation is that we're probably going to see this slow grind lower probably over the next year or two, folks. So just be prepared for that. And I think RSI will eventually make it down here to the oversold territory before we see some kind of a bounce. And now if you notice how RSI is the laggard behind the other oscillators. Okay, so it's lagging behind the other oscillators. It's moving very, very slow. And RSI is a key indicator that I can really pay attention to see where price action is going. RSI is still hanging around close to the top of the overbought territory. I think eventually it will go down and hit the oversold territory, but it may take time. It may take time. So we can see, possible recession fears come to reality. Now I'm gonna go all the way back in time and see when was the last time RSI got to oversold territory. And as you can see, it wasn't until 2009. RSI hit oversold. Look at that. Relative strength indicator dipped below the 30 level on the monthly chart. And keep in mind, we're looking at a monthly chart. So these monthly charts hold more weight than the weekly and the daily. It tells you what the overall longer term aspect looks like. And if you look at what happened here, from 2007 to 2009, we had a steady move lower for almost 2 years until we hit oversold territory in 2009 in RSI. Then we got to bounce. I think we are in store for the same type of thing now. So if you notice, a lot of folks who are buying, and I've had folks reach out to me, tell me, say, what is there to my stocks keep going lower? You know what I'm saying? I say it's because everybody's just is not paying attention to the longer term aspect. They're looking at these these nice bounce backs that the market is showing within this bear market, these bear market rallies, and they think we're fine. I say no, we're not. That's why a lot of folks are not seeing consistent gains, when they get these bounce back, they don't recover all their losses, what I'm saying, that they endured over the past 6-7 months or so. It's because that we're in a longer term downtrend that's starting to really starting to pick up steam. Now, as we approach April, folks, I mean, as we head through the month of April, as you can see, this is S&P. We're starting to get a red candle here. You ever heard of that sentiment that a lot of folks would say, sell in May and go away? Well, that may be a very, very true statement this year. On this S&P 500 chart, on a monthly chart, we are getting very, very close to touching this 20-day moving average again. And it's a little different from when we did it back here and doing a COVID plunge. That was a sudden move lower. We've been grinding lower here. If we break this 20-day moving average, folks, it could be all bets are off. It's not going to be a sudden drop just like we've seen here, but we're going to see a steady, probably going to see a steady grind lower. So we need to pay close attention to these monthly charts, folks. I think we're in this downward channel. As you can see, I already drew these downward channel lines or trend lines. Anytime we've hit the top of this trend line, we've headed back to the bottom. So it's like we are in a steady motion lower overall by paying attention to the monthly charts. And looks like all the momentum, here's a momentum indicator, which is these dark blue lines starting to form on a monthly chart. And they're getting shorter and shorter and shorter, showing that the momentum to the downside is winning the overall battle for the market prices to go lower. All right. So that is the S&P 500. And we're going to take one quick look at the weekly chart here since we're on it and point out a couple things here as well. So again, and you can see this even more defined. This is a channel that we have been in since the beginning of the year. Top of the channel, back down to the bottom of the channel, down to the bottom of the channel, and then we finally made it back to the top of the channel. And look what's happening now. Right back below the 20-day moving average on the weekly chart. It's like prices are ready to go back down to the bottom of the channel. Look at the oscillators, folks. Back down to oversold territory, back up a little bit, and look what happened. Halfway, and it's starting to turn right back down on those full stochastics. Whereas percentage made it up to overbought territory, and it's pointing right back down. RSI just in the middle, going right back down. That's a sign of the bears are really, really starting to dig their teeth into this market. And the sellers are becoming more and more motivated, folks. Okay. So for the buy and hold investors, just be very, very careful when you see these large rallies. You might want to sell in the strength, you know what I'm saying, or find ways to protect your overall portfolio. And there's many ways to do it. And pretty soon here, for those who live in the Baltimore area, I am going to be doing a in-person tutorial session on how to protect your gains in a bearish market or a downtrending market, how to add how to increase gains in your portfolio even in a declining market. And I'm going to show some folks different tools you can use, different strategies you can use, different ETFs you can use in order to take advantage of bearish or downtrending market or the cycle that we're in now. And I'll be updating you guys here soon. For those in the Baltimore County metropolitan area, you'll be able to come out as long as there's room. And I'm going to be showing some folks different ways that you can still see outsized gains in this type of environment. All right. So that is the S&P 500. Now let's take a look at the S&P 500 ETF. So it's going to look just like the S&P 500, folks. This is another tool that you can trade in order to take advantage of trading the S&P 500 to the downside by using the S&P ETF. That's a weekly chart. Look at the monthly chart of the S&P, or should I say the SPY, SPY, which is S&P ETF. Again, look at the oscillators, folks. They're starting to turn down on the full stochastics, whereas percentage and RSI just starting to hedge lower. We went down to challenge this 20-day moving average. And if I was a bet man, I would say before the month of April is out, we're probably going to break below that 20-day moving average. All right. So that's a look at the SPY. Now let's take a look at the let's go straight to the Dow Jones. Here is a look at the monthly chart of the Dow Jones. Again, folks, look at that steep climb higher. You know what I'm saying? From the 2009 lows all the way up to where we are now. Look at that steep climb higher, folks. That's a steep March high. Do you think we're going to continue to march higher like that? No. We're probably going to see sort of what we saw back in 2009. We're going to see a move. And what I'll be watching for on this monthly chart over the next year or so is a move back to the oversold levels of the RSI, like we did so right here, 2009, like we did so back here in around 1974, 75, when RSI hit. I mean, yeah, when the RSI hit below, oscillators hit below the 30 level on the RSI. I'm looking to see if that happens again, and I believe we will. That may take some time. Again, there's a well-defined channel that this market is now in, and as you can see, I've highlighted the channels on each one of the major indexes. Here we are with the Dow Jones. We're back at the top of this channel, so more than likely, folks, I think we're going to head lower. Look at a weekly chart here. And you can see the oscillators are starting to hinge lower already. Look at this. Look at the wins percentage. It's already went up to the overbought territory and it's starting to hinge lower. Look at the full stochastics. It didn't even get all the way up to the overbought, but it's got halfway and starting to hinge lower. RSI starting to hinge lower. Look where price action is. Right back up to the top of this range. I think we're ready to hinge and head right back lower on the Dow Jones. Let's take a look at the DIA, which is the Dow Jones ETF. And again, look at the wins percentage up to the overbought territory, starting to hinge lower. The oscillator starting to hinge lower. Full stochastic starting to hinge lower. RSI right back to the 20-day moving average. Price action got up to the 20 days. It's like it's stalled here. See that stall? On a weekly chart, we stalled around the 20-day moving average for the past couple of weeks. I think it's ready to pull right back down away from that 20-day moving average. Here's a monthly chart of the DIA, which is again the Dow Jones ETF, hanging right above that 20-day, which I think if I was a bet man, it's going to fail before the end of the month. That's my guess. Look at the momentum indicators. Dark blue bars are getting shorter and shorter and shorter. Look at the full stochastics starting to hinge, turn lower. Wins percentage, oscillators turning lower. RSI also turning lower on the monthly charts. Let's look at the Nasdaq. Okay, here's a look at the Nasdaq monthly chart, and this one is even more now. With inflation fears, Nasdaq, it's like it's getting the worst end of the stick because it's heading down a lot quicker than the others. But look at the oscillators on the Nasdaq. Look at the full stochastic. We're almost down to oversold territory on a monthly chart, and I think that it's going to get worse. Look at the wins percentage. It's touching the oversold territory. The Nasdaq is really, folks, is probably going to have a horrible end of April and probably going to have a tough summer. It's probably going to really see some tough times ahead for the Nasdaq. And looking at the RSI, it's starting to hedge lower. And look at the well-defined channel again that we're in. Here's the well-defined channel. Look at it on the weekly chart. You'll see again back to the top of the channel we did, and now we hit the top of the channel. It's like we're ready to come right back down, folks. That's a weekly chart of the Nasdaq. Now the triple Qs, which track the Nasdaq triple Qs ETF, and as you can see, drop below the 20-day moving average on a weekly chart, back up to it, and what happened? Got right back up to that 20-day, and it's starting to reverse. That's on a weekly chart. On a monthly chart, we see same thing. We're not going back to the 4 weeks, so they can forget that. We can forget that anytime soon. It's like we are heading lower again. It's sitting right at that 20-day. If we break below that 20 before the end of April, we definitely is going to be a good time to sell in May and go away. Or, for those who who want to understand how to take advantage of this down trending market, you can sell in May and go away, but there's ways that you can take advantage of the move to the downside, which I will be breaking down in a soon to be in-person session here in the Baltimore County area. All right, here is the full stochastics oscillators. Look at that, it's heading straight lower. Percentage heading straight lower. RSI heading lower on a monthly chart, folks. Folks, this market is nothing that's going to keep this market propped up. So these rallies that you guys see within this bear market, don't fall in love with them. It's not like they're going to rally to new all-time highs anytime soon. They're going to continue to get sold off more than likely. All right, look at one couple more charts here. Let's look at the Russell. Here's a Russell right here. Russell 2000 also looks just as detrimental as the Nasdaq. Russell has really started to roll over, folks, in a big way. So here's this trend. There's this cycle that the Russell was in. Look at that steep move lower. Oscillators pointing straight down on the full stochastic. Win percentage already in oversold territory. RSI heading to oversold territory. So, and that's on a monthly chart of the Russell. And IWM, which is ETF that tracks the Russell. Also, good way to short this Russell by getting put spreads on this IWM. Also heading lower. Now look at a weekly chart. We're trading just below the 20-day moving average. Okay. On the Russell, on the IWM ETF that tracks the Russell. Here's the Russell itself. There's that well-defined channel, folks. Look at that. To the bottom of the channel, back to the top of the channel. And this is perfect. So here's the bottom of the channel to the top of the channel. Back towards the bottom of the channel. Back towards the top of the channel. Bottom of the channel. Back towards the top of the, towards the top of the channel. So it's about time for another move back down to the bottom of the channel. Look at that. Look at that. You can't get any more perfect than that. Up, down, up, down, and creating these highs along the way. Lower highs, lower lows. Lower high there. Lower high there. Lower high there. That just shows you, that's confirmation that we're in a downtrend, folks. A longer-term downtrend at that when you see these lower highs or lower lows being created on the longer-term monthly and weekly charts. So all you gotta do is track the movement within the channels, and you can trade this one up and the downside if you like. I am sticking towards a longer-term downtrending move where I don't have to be in and out of a particular trade. All right. So my portfolio has been set up for downward pressure on the market for a while now, and it's doing pretty well with that sentiment. All right. Okay, so that's a look at all the major indexes. Now let's take a look at some opportunities for a move to the upside and a certain, within the commodities. Unlike the Russell, the Dow Jones, Nasdaq, and the S&P, the commodities are looking a little bit stronger. Before we look at that, I want to draw your attention to the VIX, because the VIX again also tells a story. Now, VIX, folks, it's been all over the place as well. But the VIX is really telling a story because it's just doing the opposite of what the overall market is doing. So we're seeing the VIX bounce here off of the support level, and then we pretty much went right back down. Then the VIX moved higher again, right back down. Now, if we look at this area that I have highlighted here on this weekly chart, it has been forming almost around the bottom, like it's ready for a move right back up, just the opposite of the market. So the VIX is in a place where it's set up for a move higher, probably over the next several weeks, maybe over the next month. We'll probably see the VIX in much higher, probably towards the middle or the end of May. So from here to the summertime, we may see a big move higher in the VIX on the longer term weekly charts. And here's a monthly chart of the VIX. And this can even probably spell even more dire picture, because like the VIX has been doing nothing but setting up. Look at all this basing around here on the monthly charts that it's been doing. It's been hanging around the support level for quite a bit, and it's established a strong level of support right at this level. Look at the momentum indicator. Momentum indicator is indicating that the VIX is building up a launching pad. It's building up strength. Look at the light colored yellow bars that are getting shorter and shorter and shorter. That's a sign to me that the VIX on a monthly chart is building up momentum, building up base, building up a launching pad to really accelerate to the upside, probably the second half of this year. So pay close attention to that, folks. Now, before I take a look at the commodities, I want to draw your attention to two other tools that give you a sentiment of market breadth. The SPXA 200. If I can find the SPXR. Hold on, folks. Let me do this. SPXA 200R. There we go. All right. Here's another tool that I like to use to track the overall momentum of the market. And again, it looks just like the S&P. So it too has been in a downtrend, and it's been in its trading channel. So this is a tool that tracks the percentage of S&P 500 companies that are trading above their 200-day moving average. And when you have the majority of stocks trading above their 200-day moving average, normally as a sign, that's a bullish signal. But when you have majority of them that's trading below their 200-day moving average, that is a sign of a bearish momentum. And I also have a 20-day moving average plotted on here too as well. So you can see that this percentage levels got as high as 97% up in April of this year. And if we go back in time, and I told you folks earlier in last year that every time we've gotten around that 97 percentile level or above 95, the overall market reversed. So we got up to 97 back in February of 2021. Since then, the market has been, that tool has been in reverse. Back here in 2011, got up to around the level. Then also it was a reversal. 2010, 2009, got back into the level. That was a reversal. Then 2007, it got up to that level. That was a reversal. So we are in the reversal mode. It just shows that the overall breadth of the market is also weak. We're heading lower. Now, this percentile level says 46% right now, around 47%. We remember we was as high as 97% about a year ago. We ain't getting back to the level anytime soon. So that just shows that half of the stocks, 46% or 47% of stocks are trading below above the 200-day moving average, still above the 200-day moving. That means the opposite for those that are trading below the 200-day moving average. So now we got about 53%, over half of the S&P 500 is trading below the 200-day moving average, folks. That is a bearish signal. All right, let's take a look at a weekly chart of this tool. Again, well-defined channel, up to the top of the channel, back down to the top, back down to the top, back down. Almost made it back to the top, and looks like we're trying to head back down with price at with the percentages stuck below the 20-day moving average. So we're probably going to see this drop much lower than what it did in the past, maybe below 25%. And let's take a look at one more tool that tracks the overall breadth of the market. And here we go. This is a easy tool to take a look at, folks. So this, if you don't know what this is, don't know how to get here, for those of you guys who are friends with me on Twitter, here's my Twitter handle. Here's my Twitter page at GodchildTim. Come to my Twitter page, and I have this pinned to the top of my Twitter page. And you can look at this multiple times throughout the day. Click on that where it says WSJ, new 52-week highs and lows. Come to my Twitter feed. You can find that tool, and you can look at that tool every day throughout the day, and it gives you the number, the amount of the new 52-week highs and lows for that particular time frame or that particular day. Midday they change. This shows the last reading was at 4 p.m. on April the 14th. So you have the New York Stock Exchange here represented, and you have the Nasdaq represented. First one we're going to be looking at is the New York Stock Exchange. So this very first top section shows the new 52-week highs for that particular day. Look at that, 142 new 52-week highs. Sounds very positive, right? All right, let's scroll down to the bottom. Look at the new 52-week lows and see which one has outgained the other, has outpaced the other. So that 142, let's look at how many new 52-week lows. Look at that, almost well over, almost double. 278 new 52-week lows. That is a bearish signal, folks. Now let's look at the Nasdaq. So switch this over to the Nasdaq. Okay, let's see if we have more new highs created than new lows. Right now, it shows 98 52-week new highs that were created. Now let's see how many new 52-week new lows were created. Look at that, 304, almost 3-to-1, folks. That is a bearish signal. So the breadth of the market is bearish. I already showed you guys what the VIX shows bearishness, shows you guys what the overall monthly charts look like. Everything is pointing to a bearish market. So it's just getting steeper and steeper and getting a little bit worse. Every time we get these rallies, the sell-off is just continuing to create these low lows, and the market dives a little further. All right. Now for, I guess, sort of a little bit of good news. If we look at, let's start by looking at crude oil. Now, crude oil has been all over the place, but I still think there's a, crude oil got back down to its 20-day moving average, and just the opposite. Even though we got these dark blue bars starting to form on the momentum, I still think there's one more push left in the crude oil before crude oil follows overall market. But crude oil is back down to its 20-day moving average, and we could be seeing a little bounce here in crude oil. So that's on a weekly chart. Look at a monthly chart of crude. I think crude oil, folks, still has a little bit more room to the upside, possibly. So we have to see how that pans out next week. Right now, crude, WTI crude is right around 106. I think it's very possible, folks, that before crude really takes a reversal like it did in 2008, 2009, we could see crude challenge all-time highs, and that is overall not good for inflation, not good for the market. But if we see crude hit this 147, we could see the same thing happen back in 2009. I mean, happen same thing now that happened back in 2008, 2009. We could see a big flush and reversal, and that would be that could almost be a sign that we need to pay close attention to, which could tell us if the market is almost finished its sell-off, longer term sell-off. If we get that blow off top where crude bounces up here and surpasses 150, then we can almost suspect a sharp reversal will happen in crude. So something to pay close attention to, folks. If we get back above this level, back above 107, we get back above 110, we can start to see crude make a climb and then break above this long wick right here, which is above 130. If we get above 130, look out. We can see crude really take a big move higher and shock us all before it has a big reversal. So that's crude. Now take a look at gold and silver, folks. I think that's where a lot of the money is going to be made over the next year or so. So here is a look. Here's a look at gold. And if I had a drawing tool, I would show you guys how gold, and from 2008, 2009, or actually beginning of the century, 2000, gold has been on a steady climb higher. Had a little pullback from 2008, 2009, but only back to the 20-day moving average, back up to its all-time high that it hit here, and then we pretty much went down into like a valley, like a low valley. Back down, 20-day moving average, but it's almost formed what looks like a cup, folks. Right back down to this valley, back up to this trend line, back down to the 20-day moving average, like it's ready to move right back up, folks. Look at these oscillators. They look totally, it looks totally opposite from what we saw in the major indexes, doesn't it? So look at that. We got overbought back in 2020, big time overbought, came back down, and it's like we're ready to go right back up in our RSI. Same here. Wins percentage hit down to oversold, and it's like it's heading right back up. Look at the force stochastics, got down oversold, and it's heading right back up on the monthly chart, folks. I suspect before this year's out, between now and the middle of next year, we're going to see a breakout of gold, breakout to new highs, and probably in a big way. Inflation, folks, is one big driver of these metals. So keep that in mind. Look at silver. Same scenario. I think out of the two, silver probably has a lot more room to run to the upside because it's nowhere near its all-time high. Its all-time high was around 50. I think we headed there over the next year or so. But look at the full stochastics, hit that oversold, and it's starting to bounce. This is on a monthly chart. Look at that. Our wins percentage starting to head higher. RSI starting to turn the head higher. Silver and gold, folks, is probably about to break out in a major way. All right. All right. I think I covered everything, folks. I gave you guys a big picture so you guys can prepare yourself accordingly. Again, there's a lot of ways to take advantage of this volatility that was happening in this market. A lot of ways to take advantage. And I'm going to be pointing out some individual ways to some a very small group of folks here in the Baltimore area at a live session in the very, very near future, giving them specific stocks they can trade, specific ETFs they can trade, put setups for credit spreads, for debit spreads. I'm going to be showing a little bit of all of that to show folks how to take advantage of what's happening within this market. All right, folks. I know I took a lot of time on that, but I wanted to break down everything specifically to show you guys what's happening within this market and show you how, guys, what you need to watch out for, and show you some, ways that you can take advantage of what's happening within our market. All right, folks. Until next time, I'll try to get back with you guys next weekend. I've been a little busy over the past couple of weeks, so took a couple of weekends off, but I wanted to really dive deep into this after this Easter holiday weekend, so you guys be prepared for the end of April and the beginning of what's probably going to be very interesting summer. All right, catch up with you guys next time.